What's up, Outliers? Happy Wednesday. I am in the process of reconfiguring the live streams yet again. You know how it goes. Kind of just move stuff around, tinker with different ideas. And the game plan for the Wednesday stream is to revert back to something that we were slightly doing earlier, but kind of ran out of time in the prior stream cadence, where what I want to do is use the Wednesday stream as an opportunity to recap the markets super fast instead of spending a lot of time digging into just analyzing markets. We do enough of that in the other streams that I don't think it's huge value add in this context. And what I would like to do is get back to the prior structure I had developed that keeps the ball rolling with respect to building skills. So if you will recall, some time ago, hot minute ago at this point, I used to do on Wednesday like a skill development, and then on Thursday for the pro members is when we would kind of double click into that skill development stream. And I want to get back to that. And the main reason is because there's an opportunity there for us to work on practical skills during the live streams together, which I always imagine is valuable. The way that I typically think about this stuff is in the context of like, do I wish I had this? I have to adjust the screen. That's why I'm leaning forward like this. But that's typically how I think about it. It's like, is this something that I wish I had around when I was learning to trade? And that's more or less what I try to offer you. So that is my vision. And as always, if you have input or if you have any thoughts on that, I'd love to hear it. But looks like we got Dark Mark and Lauren. Great to see both of you. And let's talk really quick then about the markets. And then what I want to do is actually grab the skill development book that I have. This is something that we've built for some time, and I've been kind of building it out as a broader library. And I want to show you what I'm thinking. And I want to spend some time during the stream today doing two things. I want to walk through a recent video that I did. The skill development isn't necessarily going to be super structured because I want to be able to hit a couple things more quickly. A big thing that we do on the Thursday stream is like we pick something and we go deep. Whereas I think in this kind of context for a more casual audience in general, it probably makes more sense to touch on a handful of skills to introduce people to things. Let me show you what the origin of all this was. This isn't something that I was like just randomly going and thinking how I was going to piece this all together. Let me show you exactly what went down. So first things first, this isn't what went down. I just need this window. This is what went down. So this is a post that I made. Hey, what's up, James and Robert? Good to see you as well. This is a post I made yesterday on Reddit. Every once in a while, as you guys know, I like to go on Reddit because I believe it's valuable. Like, I really believe it's valuable to go back and give back to the community. And there was, looking back at my own trading career, there was a ton that I learned from different free discussion forums. However, I do typically think that there's I don't want to like discount it too much, but I do think that there's a general lack of good information. And I think it's hard to also just come across people that genuinely give a certain amount of care in terms of, you know, like what we're doing. I'm just setting up windows. That's why you see all these grid lines. In terms of like what we're talking about, how we're talking about it. Okay, this goes back to the skill dev promise. I was in the process of talking about this. There's really nothing here. The concept behind this is stuff that you all are well aware of already. This simply is talking about the idea that the important stuff that you do as a trader really doesn't change with account size. This might not even make sense to you. You might be saying, why would that even be a thing? Well, it's because there's a lot of traders, I see it all the time, where they genuinely believe that trading is going to become easy once they have more money. Like, that is a genuine belief. And as you could tell, there's a lot of issues with that belief. It's more or less just going to set them up for what I typically would consider a pretty significant amount of failure, realistically. It's just not how markets work. So that all aside, I made this post, and the interesting thing to me was actually in the conversation I was having with somebody. And somebody had responded here. Yeah, perfect. This has been a really good dialogue. Now, I spend way too much time doing this stuff, going through these. And the main reason why I do that is literally just because, like, I actually care. And if somebody doesn't care and take the time to do these back and forths, that's real difficult to learn, right? You kind of just get off on your way of thinking and there's no intervention. And there's a specific thing that I was thinking about when I was speaking with this person was I remember when I was a few years into my trading career and I was genuinely convinced of certain things. One of them was I could not wrap my mind around the concept that rolling is simply closing a trade and opening a new one. I just struggled with that. It didn't make sense to me. I thought rolling was this really cool thing that was, big game changer and all this kind of stuff. And as everybody knows, it's simply not the case. It's just objectively not the case. Yet, that's what I thought. And it took me a long time of like noodling on the thoughts, hearing the thoughts in different ways, discussing it with different people, because the tricky part with rolling is most people agree with that. So it's actually really difficult to find counter arguments. And I forgot how I think it was in a book that I came across, somebody referred to it literally as just like closing a trade and opening a trade. And I was just like, what? That's not what this is. So anyways, this person reminded me of that because we're going back and forth on this here, right? So the concept of the post, the amount of money you have doesn't matter that much in the context of being able to do the important things, right? So the idea here, and you can see in the TLDR, having a large account isn't like some sort of binary switch, no edge to edge. It's just not how it works. But there's, again, a lot of people that relegate it to, oh, once I have more money, this will be easier. There are elements that become easier with a large account. No debate. Completely agree. Things like portfolio margin, PDT, yada, yada, yada. There's tons of things. And you guys saw when I did the small stack segment, how annoying that was for me, because trading a $5,000 account really is annoying. Like it is. So there's no debate. And I would never sit here and pretend like, oh, that's not the case. That would be absolutely ridiculous. But that aside, there is absolutely nothing magic once you have a large account that somehow will just make you profitable. That's the problem. So anyways, this person says, to be fair, if you cannot get a level high enough to at least use cash secured puts, then it can actually be difficult. And you can see my response is this. It's always difficult. There is no, it's not once you get to CSPs, now it's easy. It's not. It's never going to be. I made a post on here. Let me find it real quick. I made a post on X that looks at this topic. Let me find it. Here. Because I was just doing some general research and I came across this topic, which also, by the way, before I show you that one, I want to show you this other one here. This I thought was fantastic. And it was like so perfect based on, what I was just kind of noodling on before coming on the stream. This. So the more we learn, the more we realize how little we know. It was so funny. Like I didn't go looking for this. This literally just popped up in my feed. And it was as I was having this conversation, thinking about all this other stuff that I was telling you about. So Then the conversation goes on to this. It says part of the edge is being able to sell options and the strategies associated with them. Aha. The first inaccuracy. There is not an inherent edge to selling options. It's one of the most commonly mistaken things I see when we talk about trading. There are so many traders that are genuinely convinced that selling options is an edge, and it is not an edge. And you'll see a little bit more. But again, back to why I want to do skills dev, because taking time to talk about these concepts on a stream in passing more quickly, I think yields really high returns at the end of a stream. Because at the end of this, you can literally walk away and like definitively point to hopefully a handful of things, concepts that either become more clear, new concepts that can send you to go do research a little bit more deeply. You can walk away with like practical things. So that's what I want to, that's why I want to do the skills dev. But anyways, let's just continue with this one, because this is, again, an interesting conversation. It's already been statistically proven that selling is more lucrative than buying. As soon as I see this, the first thing I think in the back of my mind is I'm assuming they've watched Tasty Trade, because Tasty Trade actually doesn't say this because they know better, but it's how people typically think about what Tasty Trade says and internalizes it. Because again, you guys know I do podcasts. I talk to Tom pretty regularly. And the hilarity here is that they also would say the same thing. But most people, they see information and then they take it the way that they want to take it, not the way that it objectively is. Okay, so we talk about this in my retort, but like this isn't true. So the first premise that they're saying to me, that being able to sell or having access to selling cash secure puts leads to edge. Again, I couldn't care less if I change their mind. That's not why I do this. I do this because I think that it is really, really important that once you actually learn and understand something, to share it. I really believe that. And it's the only reason why I've landed where I am with respect to my trading acumen. It's not like I'm some savant that just magically knew how to trade options. It's not how it went for me. I've had so many people help me in so many ways that if they had not at various points, I assuredly would have had a completely different path in life, assuredly. So I view this as a general service to the community. As corny and as wild as that sounds, that's why I spend the time doing this, because this person represents not just this person. This person represents a train of thought that other people have, because I've seen this a ton of times. And my hope is that not for this person, but there could be another person or this person that follows this logical conversation, because they're also a great conversationalist. There's nothing mean in this conversation. As soon as people get annoying, I won't talk to them anymore. But like, this was a completely solid discourse, right? The process of they think this is the reality. And again, it's not until somebody shows another way that they will realize that this isn't the reality, but somebody needs to show, or at least plant the seeds of something to research further. So anyways, incorrect. This says you're basically forcing them in predicting price direction with calls and puts. If they have a low enough level, you force them into covered calls, which is, that stuff's all wrong. It doesn't even matter. But the predicting price direction, this is another really common premise of people who think selling is an edge. They will say things like, oh, well, I don't have to predict direction. Guess what, gang? If you sell, you still are predicting direction. You just have a pad. That's all, right? So if we think about a cash secured put, fantastic example. And if we look at the payoff diagram for a cash secured put, what does the payoff diagram look like? If it looked like this, then this would be correct. But this isn't what it looks like. You all know this. The payoff diagram for a cash secured put is this. What does this mean? It means you still have to be directionally correct. The only difference is that you have a small buffer, emphasis on small, several percent, typically somewhere between 5 if it's something with super high IV and 1%, something like that. I guess I should have reversed those numbers, but so. You have a small buffer. This doesn't mean that you don't get to be, you still have to be directionally correct. You just have a buffer. But again, I don't bother addressing that part in this post because it's too much. It's way too much. I hate, you guys all know this. I literally hate the written format because it's super time consuming. It takes forever, right? Like even in the few minutes that we've had this stream going so far talking on this specific topic, we've been able to talk about a ton of different things that would have taken me literally a very long time to write out. Okay, so then I essentially say selling absolutely is not more lucrative than buying. It's patently false. And then I think this just goes back into tying it to the original post. Some people, like right now, you could tell their argument is now about, is selling lucrative or is cash securities lucrative? But like, that's not what the original post is about. The original post is that the major muscle movements that you need to do as a trader literally can start when you have $0 fucking dollars. You can do it with $0. So just making sure that we're bringing it back to that point. Again, this isn't for them. This is for somebody else that's following the dialogue. Okay, so then they respond with strategies that involve selling are absolutely more lucrative than strategies that involve only buying. So here's the problem when people argue things is they add these different qualifiers that niche this argument down, right? It's already moving. And now the target is that involve only buying. Big difference, right? At no point would I make a counter argument to this. I wouldn't make either side of this because this, again, is a completely moot point, and you'll see why. Again, I'm using statistics and large sample sizes here. This is the problem. They're not. What they're doing is repeating something that they've heard from somewhere without doing any other research, and they're just trying to regurgitate it while bastardizing it. I'm pointing this out because this person truly believes this. They think that the statistics are on their side. And again, fun fact for those that don't know, my undergrad and grad were both wrapped around stats. So it's literally what I do, at least from an education perspective. Now what I do is just look at colors on a chart and lose my money all day. It's pretty fun. So then they talk about like different strategies and stuff. And here, this, I didn't accuse or I didn't say like, oh, you're just regurgitating Tasty Trade. I was given the benefit of the doubt, but here it is. I agree that it's usually best combined edge, technical fundamental analysis, which is funny because Tasty Trade doesn't care about technical analysis, but as Tasty Trade have proven, right? So that's what they're citing. And the problem is I give them a lot of context here on the way Tasty Trade does studies. I like Tasty Trade's stuff, but their studies have a litany of shortfalls like everybody's studies. There are no perfect studies out there. And moreover than all of this, shout out to them for putting the studies out there, right? The fact that we can have a conversation about this is huge. So I have nothing but respect for what they do, but it still requires the same scientific rigor of analysis as anything else. And what you'll notice most frequently in their studies is they typically compare what we would refer to as a dumb strategy. And it doesn't mean that the person using it is dumb. It just means that we're essentially saying this is what we're going to do over and over again into perpetuity or until the end of the study, right? And I give an example. So a lot of times they'll do stuff like, if we buy versus sell a 16 delta strangle in SPY every 30 days and go to conclusion, that kind of stuff. So it gives you a premise to begin, but their takeaway is still wrong. So here, the last thing I say was that I talk with Tom and that he will admit himself that selling has no structural edge, meaning it's not better than buying, and simply saying that Tom would also say that. And he says, well, that's contrary to everything I've ever heard him say. So again, they're convinced of this. And you'll see in a minute, this is, again, just wrong, but that's okay. So I don't know where you're getting your information from. This is them going through the doubting process because they're having somebody directly discuss these points, and it's disrupting their view, their understanding of the world. And they're being confronted with new information that makes them question the background of what they're doing. And that's not easy. That's very difficult. And the cool part is once you trade for a while, it actually becomes super easy because you learn to not really care about right or wrong. And you really do just become interested in what's accurate and what's objectively true. And for those that have been in the community for a while, you will have heard me say things like strong convictions loosely held. And it's a really important premise. And it's simple. Strong convictions, meaning it's something that's well researched. Loosely held, meaning as soon as there's new information, you can immediately abandon that strong conviction. That's it. Strong conviction, loosely held. So then they say, I don't understand. There are very few option strategies you could do with calls and puts along. I don't know what that means. You're limited. The fact you cannot dispute. You have to rely on creating edge through technical fundamentals, some other analysis in order to profit from calls and puts, just as you would trading equities. So again, this is just confusion. It's not really worth diving into. But this goes into a common misconception that there's some sort of option structure that equals edge, and there isn't. So it doesn't matter if it's a CSP, it doesn't matter if it's short puts, doesn't matter if it's long calls. None of them inherently will yield edge. It's the strategy you build around them that ultimately does. And then here, saw this one coming from a mile away because it's super common. The idea that if you sell, the advantage is being able to benefit from time instead of it working against you. And again, this is a just general misunderstanding of some of the most important trade-offs that exist with options. The thing you have to remember is everything, literally everything has a trade-off. There is no free lunch out here. So this concept of, selling being able to benefit from time and instead of working it against you. That's absolutely correct. That's 100% true. If you sell, time helps you, does not hurt you. But what does that mean? You guys tell me. What does that mean? If selling allows you to benefit from the passage of time, what does that mean? Any brave guesses? Hey, yo, what up? Why not? Joe says theta decay. Yeah, that's correct. That's what it is. But tie it back to what we're talking about. If selling allows you to benefit from theta decay, Reese is getting closer. You need it to not move too much. That's partially correct. Not what I'm going for yet. But zooming up a level. Any other guesses? Bam. H has it. H has it. There's a trade-off. So one of those trade-offs is defined profit. So you get theta. Here's your get. You get theta. Here's your give. Profit potential. Your get is a little wiggle room, meaning it can go against you a little bit and you can still win. Your give is gamma and convexity. This is your cost. Now, I'm not saying that these are directly linear. It's not so much the case. But for every single component that you get, you are giving. And it's for both sides of the equation. Whether you buy or whether you sell, there are things that you get that are inherent strengths. It's just like if you play a video game. If you play a video game and you're playing one of these like fighter video games, and they all have like their stats, or maybe a sports video game, right? Like different things have their stats, different offense, defense. And sometimes somebody will have really good offense, but not a great defense, and so on and so forth. Maybe somebody's really good at like close quarters battle, but they're really bad at distance, or they can't even touch you at a distance. It's all that kind of, it's the same thing here. The same exact thing here. Peace says, is there such thing as too much theta? That's a great question. Now, I would say not as like a standard rule, meaning if you go over, so like if theta exceeds like 500 units, if you exceed 500 units of theta, that's now too much. That's not how it works at all. I would say that you can have too much theta relative to a portfolio size, more as a representation of position and position size. Because if we need theta, let's say if theta goes up, meaning you're collecting more theta, it means something has gone up, whether it's the number of trades, size of trades. This amounts to risk. Risk has gone up. So this is relative to a portfolio size, however. So I would say that there is too high of a theta, and it's more not because it's too high of a theta, but it's because as your theta increases, it means you're adding risk in some way. Again, you're either adding total number of trades, size of trades, so on and so forth. One of those will be moving. It's a great question. So that's how I would answer it, though. Inherently, there's not like some sort of threshold that's defined, but there definitely is an implication relative to sizing. Okay, so let's continue. So this just explains a little bit of the history of Tom and why they prefer selling. And a big part of it is he started on the floor making markets. And as you do that, you're just primed to take the other side of the trade. And more often than not, at the time, it was selling because most people would be buying. So that's the inherent tilt that begins. And that's part of the contrarian mindset that he generally exhibits, which is cool. Ain't nothing wrong with it. This talks about the different strategy compositions. We already talked about this. Now, this addresses what we were talking about with respect to time. We already know this. A lot of the times, by the way, when you have these conversations with people, again, not just with this person, I view it as having a conversation with this perspective that likely other people have, is give them resources. Because a lot of times people are just so used to people arguing, I want to be right, I want to be right. And they're not used to people arguing from the pursuit of objective truth. And I would say this person's actually doing a great job so far because it's a very just generally logical conversation that's respectful. So this is rare. But one of the important things is give them other things they can look at, because right now, for most people, they're thinking like, oh, I'm in a fight, I'm in an argument with this guy, I don't want to lose. So then it gives an out. It's essentially saying, well, don't just take my word for it. Go look at other resources that talk about this concept. And a great one in this exact thing is Ewan Sinclair. So anyways, I give them the Cliff Notes version of why selling and buying are, the relationship that they have. And then they ask like where I got my like information from. I literally just Googled like a keyword search about this. And then I've never used Imgur before, but I figured out because you can't add like a screenshot. This is literally from from Tom. Since the market is efficient, we cannot claim that one side is better than the other. Long versus short premium. Literally, the dude is saying it himself. And it's not like some sort of like big gotcha. It's just a fucking fact. So anyways, I gave them a direct source to help them wrap their mind around it. And then now we're talking about simply stating that absent any other edge or strategy, right? Like this is different now, but that's okay. Strategies that contain sell orders collectively have higher pop than those with buy orders. So you can see how the argument has evolved, right? And this is super common because when people are getting pressed and as they're turning left, there's something there, they try to turn right, right? They're trying to navigate the argument because as you could tell, like this hasn't been mentioned at all yet. And we're 8 back and forths into this, which is again, okay. But they're saying that sell orders have collectively higher probability of profit. It's completely true. Now I get an opportunity to teach them about another really annoying fact of trading. High probability of profit doesn't equal edge. We now have to talk about a super, super important discussion about expected return, right? So here, this is saying high probability of profit does not equal edge. And then I give them an example. So they say, okay, so what does pop mean then? By your logic, it's a completely meaningless statistic. And they're not far off. Like realistically, pop by itself doesn't matter. It doesn't tell you really much anything of use. And I give them an example. So I say, if I tell a trader they have a 90% chance of winning, they might think, and most of us would think, wow, that's awesome. It's a super high chance of winning. I like that. But this doesn't reflect trading. This doesn't reflect the markets because we know that there are other pieces to this puzzle. Not only do we have the probability of our trade, our probability of a win, but we know that we also need to know the win size. That's another key part of this equation. And we also know that for every strategy that exists, there's a probability of losing with a corresponding loss size. So what did we just do? We just wrote the expected return formula. And again, a lot of people really like focusing on win rate and probability of profit, this one input, 1/4 of this more important equation, because who doesn't like winning a lot? Everybody would like winning a lot. Everything else being the same, we all would rather win a lot, of course. Remember, trading is a game of trade-offs. This is a big trade-off. If you have a really high probability of profit, it means in general, your win size is going to be lower. Your probability of losing is lower because these two are connected here and here. However, your loss size is typically higher. These two also have a relationship. These two, I think I'm at the bottom. These two have a relationship. So what I give them is a scenario and I complete the scenario. I say, now if we actually put this in a trading context, their 90% probability of winning comes with you win $10. And that 10% probability of losing has you losing $100. Here's the problem. Once you add those other components, you now have a negatively expected strategy, even though it has an astronomically high probability of profit. And then we offer another example to help elucidate the point, which is if we have a strategy that wins 35% of the time, really small win rate, but you win $100. And if you lose 65% of the time, but you lose that $10, you now have a positively expectant strategy. So in this one conversation, we had an opportunity to discuss a ton of topics. We got to discuss some of the key components of being a trader, not being related or directly tied to the size of the account. There are tons of things you could do with $0, let alone a big or small account. You can start with no money. That's the first thing we learned. The second thing we learned is a relationship between buying and selling. And there are things that you get and give, whether you're on one side or the other. But we learn that one side is not inherently better than the other. We learn that the concept of theta being an edge is false. We also learn about the concepts of convexity and gamma. So we're on to 7 things so far over the course of this one post. We got a chance to learn about high win rate and overemphasis on win rate and how that can be confusing. And we had a chance to learn about expected return and the integration of probability of profit or win rate into the broader expected return calculation. There's like 10 things over the course of, hour long. Well, it wasn't even an hour. It's like posting, right? So you go back and forth. But 10 things we got to talk about over the course of this one dialogue, which to me is absolutely beautiful. I love that. I love the ability to have these kind of conversations because I think they're so important. Now, I do have a genuine question. So for anybody in the chat, I think you can, yeah, perfect. It should just say yes or no. Yeah, perfect. Was anything in here new to you? Yes or no? And you could throw it in the poll. My guess is the majority for you, hopefully this stuff is not that new, but I am actually curious. Like, if there was stuff that we talked about in here that was new to you. Interesting. Even a slightly higher yes population than I thought. For those that said yes, what element was new to you? I'm genuinely curious. Because part of what I want to do here is talk a little bit about this. And this is what I have built out for our skills development sessions. I just kind of like passively add to this over time. But I would like to add more stuff to it. So depending on what the generally new stuff was to people, I would love to include that here. As expected, most folks are generally familiar, and I'm assuming these are just people that have been around the community for a while. But yeah, if there's something that you would like to add to our skills development segment, let me know, because I'd love to include it. Okay, I'm gonna kill this poll. And I have 2 other things that I want to talk about. The very first one is taking a look at this video, which I think is, I got a handful. I actually got more emails on this one than anything, which is kind of funny. And so this was a video that I released for like the weekly video that goes out on Sundays, talking about a recent trade in CCJ. And one of the questions was this one, or it's not a question, it's a comment. And I actually think it's a really great comment, by the way, because it highlights a really important point. And they're saying, I feel like for every one of these unusual options ideas that hits, there are 100 that don't do anything. What do you guys think? What do you make of that as a statement? Thoughts? What do you guys think? Because there's a really, really important element to this. Actually kind of fun seeing like where different people think about stuff. Lauren says, how big is the one that hit versus the 100 that do nothing? That's part of it. So you're getting into the expected return calculation, and you're getting closer to the broader idea that I'm thinking of. H says, makes me think of survivorship bias. There's definitely an element of that without a doubt, but that's not what I'm thinking of. Think of it this way. There's over 5,000 securities that you can trade. Jordan says, I'm not so sure. I think scanning for stuff is a skill and you can get very good at it. There you go. Jordan's on the right path here. A big part of being a trader is learning to be supremely efficient with your ability to look at the markets. And it's because you are working with constrained attention. There's only so many things you can look at. Thor, stop that. He's digging into his bed. So there's Thor, no. There's that element. Now, the follow-on element is you can learn what filters make sense for what ideas. And it's always, in my opinion, about the breadth of evidence, not any one point. And we go through this a lot during the pro streams. We scan together all the time, and you see exactly what I do. A big part of it is starting with a series of filters that I know narrow the world down to different ideas that I'm interested in for different reasons. It's not the scenario that I go through that result list and then just start firing off trades, right? Just doesn't make sense. I then apply another layer of analysis on top of that to then arrive at a trade idea eventually. So what they're highlighting here is actually a massively important point. And it's that you can't just blindly trade a certain set of criteria. It still requires your eyeballs. Now, again, this is me speaking from the context of a discretionary trader. I am a discretionary trader. I cannot automate what I do as a trader. I know this. I can automate different components of what I do as a trader, but I cannot automate what I do as a trader. And it's because of the discretion component. It's very difficult to quantify all elements of a trading decision cycle. And that's, to me, that's not a problem. To me, that's part of my edge, is that baked in experience that's built on over decades in the market, that intuition and that subconscious processing that cannot exist in an automated system. Automated systems are black or white. Does it fit the things that this is supposed to fit, even if it's ranges, and then enter or don't enter? That's it. Whereas from a retail trading lens and discretionary trading lens, there's way more shades of gray. And to me, that's part of the beauty. There's more to it. So this trade was actually a really, really simple idea, right? It was based partially on the concept of a breakout. So you can see the positions that went on and how they went on. And I had scaled this one, if I'm not mistaken, to the $600,000 model portfolio that we've been using. I just think it's good to kind of keep it in a common language. So all I did was take the position and made it relative to the portfolio that I've been sharing with you guys. And you can see I just give some of the background on the idea. I talk about formulation of a trade, blah, 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 blah. And then I give you the actual decision cycles here. Now, when going into this trade, there's no part of me that's like, I know what's going to happen. I have absolutely no idea. You guys have seen me talk about plenty of losing trades. I'm not ashamed. Like, they're part of the game. I'm not ashamed of them at all. It's just another data point. The thing is, the goal of a trader is to just steadily put yourself in increasingly better positions to capture good opportunities. That's ultimately what we're trying to do here. So I thought that comment was like, I felt it. I felt their energy in the concept of what they're saying, because that is the case. And it's a really frustrating thing to navigate through as a trader. The fact that you have to find a way to navigate this stuff, and there's not like a simple rote thing that you can always do. There's nothing like that. That's annoying. And that's kind of difficult actually to fully get your arms around. But it is the reality that we have as traders, which again, I think that's where a big part of the benefit comes from what we do. So if you have any questions on this video or this trade, let me know. In the meantime, if you have any questions that you want to talk about, now's the perfect time to throw them in. I want to hit one of these from the pro members. And the question here is credit spreads. I'm bearish on 5 reporting earnings. Max move after earnings is based on historical move was about 15% to the upside. Let me wrap. Nope, didn't mean to do that. Let me wrap this so I can see. This would end up with them shorting a 20 delta strike at 130. I'm trying to figure out my long strike for the wings. I'm using theoretical numbers, but what is the difference between shorting 2 credit spreads that are 10 wide, 1 credit spread versus 20 points wide? Seems like both are risking a max loss of 1,700, which is correct. How are these two positions the same or different? I know you aren't a fan of credit spreads, but what would you tilt higher? Wider wings or the spreads? What are the cases for one or the other? It's a great question. It's actually a really, really perceptive question too. So let's talk about credit spreads really fast. And instead of drawing, I'll actually pull it up in the platform because I think that might be a better learning tool here. So let me close that out and let me move this over. And let's take a look. Let's take a look at the idea. Let's take a look at 5. And we want to be short in this scenario coming into earnings. And they're at 125 by 128. So they're getting ran over, but not too bad. Because if the short's at 130, the trade would still be safe. Let's take a look at the different scenarios. So let's look at 130 and 140. Call side. 130 and 140. So this would be 2. And then let's take a look at 130 to 150. And that would be 1. Okay. So now let's take a look first at this version. And let's just talk about it. Let's just talk about what we see. So the first thing that we would want to analyze here is what is our, let me move this up so that you guys can see the trade details. There you go. So let's do first the $10 wide spread. And we already arrived at the max profit effectively being about the same. I'm just going to call it the same. It's not. This is slightly different. Max profit on these is slightly different. So this is 530 versus 520. So we have the 10 wide and the 20 wide. 2 by 10. So max profit is 530 versus 520. If we take a look at the max loss, 1470 and 1480, right? So just the inverse of this. And we both know that the short strike starts at the 530. So if we were to reason through the differences here, there's a few key elements to keep in mind. What are they? Brainstorm with me. What can you think of here that's different? And there's a handful of things that I think will be most relevant, but let me know what you guys think. Any guesses? And in the meantime, I got to add the timestamp in this before I forget. This is 55. Oops. No guesses. No way. You guys have to have guesses. You absolutely know some of the differences here. Okay, let's start with the simple stuff. The first one is super easy. This. One of them has 2 legs. Or 2 contracts. 2 lots, I should say. So 4 legs. One of them has 2 legs. So we know the first thing is that there's going to be a difference in terms of cost and liquidity. Now, this doesn't inherently mean that the 2 lots with 4 legs, 2 lots, it doesn't inherently mean that this is more or less liquid than this. It depends on the options. But let's say you're dealing with illiquid options, then this is worse. If you're dealing with liquid options, this might not be any worse than this. Really depends on the options chain. But there's a cost component. There's definitely a cost element, right? 2 legs versus 4 legs. And you have to do that round trip, entry and exit. So that's one thing. The next thing, we know that the initial probability will be super similar because it's based on the 530. So if we take a look at what the break even is for the first strategy, it's at like 135, 135.20, and I don't know why I said 530. Must be thinking of like SPY or something. B1. My bad. So we easily can calculate the break even, and the initial break even, as you know, is just your short strike. So in this case, 130. And we get our credit added on top because it's a short call. And again, our credits respectively are about the same. It's 530. Oh, this was profit. That's why. So in one scenario for this one, your break even, let me get rid of this stuff. Your break even is just your 135.30. And then in the second scenario, it's 135.20. So about the same. So now if we think about where max loss occurs, this is where one of the first main differences will come. If you take a look, your max loss of 1480 in this trade comes in at 150. If we take a look at your max loss on this trade of 2 of the 10 points wide, where does your max loss come in? At your short strike. So your max loss here comes in at 140. So that is one of the primary differences between these. Your max loss is at your long strike, sorry. So your max loss in the 10 wide is at 140. Your max loss in the 20 wide is at 150. You have a 10-point window greater on the wider spread with fewer contracts. Big difference. So this is one of the dominant factors that I would point you towards. The rest of it is very, very similar. Now, there is another element here, which is the probability of being in between the strikes. So if you're trading this for earnings and there's big gap potential, you don't necessarily want to be in the middle, right? Especially if you're not paying attention, if there's risk of early assignment, if you're planning on managing and stuff like that, it's negligible. But if you're planning on, like maybe checking and there is a risk of early assignment, it's not the end of the world as long as you have the long wing. It's not going to break anything. However, there is just a different logistical thought process that goes into 10 wide versus 20 wide, because the probability of being in the middle between the strikes is a little bit different. So not a huge deal, but something certainly to be aware of. So yeah, I mean, this really summarizes most of it. There's a couple other nuances that I think you could point to, but most of them don't really matter that much. These are the main ones, I would say. So that's what I got for Senor Sky Omen. Any follow-ups on anything that we just talked about as we were going through that? Land says, can you walk the dog on MNMD? I know the stock well. I've been following them for a while, funny enough. Explaining specifically what filters you're working your analysis through. And why, for fellow Marinus, any profit mechanisms opportunity. Okay. So one of the first things that I would see here is the way that we arrive at this is different than the way that I often arrive at trades. More often than not, the way that I arrive at trades is by scanning. And then if something passes the filters of the scan. This is an inverse scenario where we have a ticker that we're interested in. And then the question becomes, is there something here that can be done? And there's nothing wrong with this version, but that's a very important distinction in the way that I arrive at trades. And this one is that latter scenario where we're just saying, I'm interested in this one for some reason. Let's see if there's something there. That being said, it almost always in that way would start with a fundamental analysis review. This, for me, is super important, especially in stuff like this, that I don't follow that closely. Things that I have a much closer relationship with, I can skip a lot of that because I might already know a ton about the stock, like Nvidia. I know about its earnings, I know about its sales pipeline and all that kind of shit. This one I don't. So this is actually a great example because it's one that I'm familiar with. I followed it for a while, but I'm not that close to it. So we literally can start with just like we do in the military, and it's kind of a little bit of a leader's recon. This is me where I'm building in contextual understanding and an orientation of the underlying itself, which is important. So as always for me, I start with just what has this thing done over its lifespan? So we can see that it IPO'd in like the ones, rallied super hard up into the 50s. This is important for me to know because these people here are praying for an opportunity to get out. They've been in this thing, a number of them, from 2021. And it's been underwater the entire time, 10 times lower than where they got in. So this group of people will serve as pretty strong overhead resistance. Again, they are just hoping for an opportunity to get out. Okay. So now if I zoom in a little bit and get a little closer to the near-term price performance, I'm actually going to change this one in this context to a 150-day instead of a 200-day, just because it hasn't been around as long and it has a much near-term specific price pattern. The first thing I notice is generally downward sloping price behavior. Again, it's cutting off these, so it's not technically correct, but this is just the general trend we can see. And this is obviously also represented in the standard deviation channels, which are negative sloping on a 1-year time frame. That's not good. The other thing I notice is a lower low posted here as compared to prior. So we can see a low, higher low, slightly lower low, a higher low with a higher high that then reverted down super hard into a lower low relative to here, a lower high relative to here, a new lower low relative to here. So this shows a change in trend. And then we see consolidation, and then it starts to rally this direction. So now we're presented with a higher low, about a same high relative to these, then a small breakout, consolidation, still with a lower high relative to this, but a higher low relative to this. So this is something that's just oscillating heavily in between accumulation and distribution phases. And you can see that represented in the moving averages. They're just essentially wrapping around one another, trending almost sideways. So that's really common for things that aren't able to develop some sort of like actual trend for themselves yet. Okay, next, 6-month time frame to zoom us in a little bit more. I see same negative slope and standard deviation channels. I see still overall bearish price. I see pretty significant overhead here. And again, you can see that represented where price came up, literally touched the point, the secondary volume node, I should say here, not the point of control, secondary volume node, and got rejected down. Again, these are typically people that are just happy to get the fuck out, that for a while were like, oh shit, I got in way too high. And you can see that there was a pretty meaningful volume node here on a 6-month time frame. And you can see it literally touched it and got rejected down. Doesn't always happen, but it does tell us that there's an appetite for offloading at this level. Then you can see that it consolidated well at this volume node. The consolidation is a little wide for my preference, but it's fine. And then we see it slowly trending using a short-term moving average. This is a 10-day moving average, which is good. The 10-day is now above the longer-term moving averages. We can see the 20 period is here, 10 above 20. We can see both of those are above the 100. I was curious where the 50 was. The 50 is lagging a little bit. So let me get rid of this one. We don't need the 100. And we'll get this one the correct color. Just trying to clear up some of the space there. So there's a couple near-term price levels that become interesting to me right out of the gate. The very first one is how does it behave? Again, like, is it able to like meaningfully break above these handles like this here first? A big thing that I would track as it does that is how does volume move, right? So it did get some pretty good expanding volume against longer term averages, the 20 and the 5. But you can see that the 5 period volume average has contracted meaningfully. So that tells us that overall volume is slowing down. And we know that it's going to need more volume to break above, especially where the sellers are happy to offload. We can see a bullish drift here. And this is actually pretty aggressive. So I envision it looking to make a decision pretty soon. Now, based on just a loose technical analysis like we talked about here, my intuition leads me to think that it looks like it generally wants to continue trending up. However, it really seems to depend on an upcoming catalyst. A big part of that will come from this earnings, which we need to look at. It's unfortunate that it looks like it came in right on target. We'll have to actually look at the earnings though and see what kind of guidance is there. Now, next thing I want to take a look at is the fundamentals. And I just want to get a sense of how it's been trending. So this looks pretty good. A pretty meaningful year over year change. And then quarter over quarter, general trend is good for EPS. We need to get a look at like sales data and stuff like that. So we'll have to grab another view. Because that's really the next main thing I'm interested in here. So let's take a look here. Now, again, for context, this is still me literally just getting context. That's all. None of this means a whole lot to me yet. So EPS. Yeah. Let's take a look at important stuff. So liabilities coming down is good. I really care about sales. We need sales. Let's take a look. No sales? Is that correct? MNMD sales. No, it looks like it has. Oh, no, that's insider stuff. Let me take a look at its recent earnings release. I want the actual earnings release. Here we go. So I prefer to go to like the actual company website. So let's take a look at their earnings release. So it's in a phase 3 for this treatment. So this starts to become an important, like they're in a tenuous point here. This is just talking about the conduct of the study and where they're at. And then this one is for like autism, which is a little bit different. I don't think that's like their main, I don't think that's their main bag. So they have 245 sufficient to fund the company's operations into 2027. So this tells me that there's not necessarily a significant revenue source, and they're using these investments to position themselves. R&D 23 mil, general admin 8.8. Jesus. These are the kind of things where, yeah, like this. These are the kind of things that I like to keep an eye on, because if the company itself isn't profitable, I actually care a lot about what the comp package looks like for the leadership. So I'm going to ask Gemini, what is the compensation package for MNMD leadership? And let's see if that can find an answer. And I'm also, as you guys know, I like to look at different ones. So I'm also going to ask ChatGPT. And then I will also ask Grok. And then I will also ask Perplexity. And let's see what answer we like the best. As of a report around 29 May, the CEO, Robert Barrow, their annual compensation was $2.67 million. 23.4% is salary, 76.6% is bonuses. That's fucking crazy. That's fucking crazy. ChatGPT corroborates. It says 2024 total comp 262.669. Base was 623. Incentive plan 359. Other comp 14. Stock awards not disclosed. Super Grok generally confirms 22. It goes back to 2021, which is a little bit longer than the others. And then Perplexity comes back 2.67, which is correct. So then other key leadership, the chief medical officer is 1.3, chief legal officer 1.16, executive president 2.66, like we talked about, co-founders 501. That's fucking crazy for something that's not profitable yet. That's crazy that they're paying that much to those people. I hate that. So that's that. Now let's take a quick look at the options markets and see if there's anything interesting in here. I'm actually going to start in the platform a little faster. So it looks like general expectation to upside. And it looks like Landrush says FDA legislation, and it looks like people are positioning for a bullish play on that because there's a little bit more call side build out. It's still not a ton. I do want to look at term structure, and then I want to look at low. So this is interesting. There's definitely something expected in the 20 June expiration, like without a doubt. Yeah, without a doubt. And that's printing at 82% vol. And then let's take a quick look at the actual options chain. I want to take a look at the actual premiums that are sitting. Big call side, big call side. September. About the same. These are all like small though. It's like 3,000, 20,000. Like these are all pretty small plays. 34 up front. This is the most noteworthy by far. 34K here against $735. That's nuts. So that's, I mean, like the biggest, that there's just no big players in this as we're looking at it. That I think generally is coming through. And this is just somebody that's buying units. And this was on the 28th. It's still not massive. So the options market looks like it's indicating a slight bullish skew, but it's not massive overall. It is generally large relative to it though. There's just not like a ton of players in it. So that kind of affirms my broader idea that it seems like it wants to drift up, and it seems like the market is pricing in some sort of event or piece of news, a catalyst that's expecting to the upside. But this mostly looks like speculative positioning based on what we can see from the premium positioning, right? So like if we take a look at OI, you can see that the OI here is at 8, 10, 12, 15, 20, and 22. So most of it is like pretty high. Even the 7, that's at the money. So most of the OI is sitting out of the money, which is directional. And you can see a really big percent change in the 18 July build out. That's actually a really significant change, right? So like 51% added to the 18 July on the call side, but it's low overall numbers. So it's not necessarily huge because it's a small stock and the current OI is not that big. So summary, not profitable. I vehemently dislike the fact that the leadership team is compensated as heavily as they are. I think that's psychotic. I think the options market and really the price behavior seems to be indicating towards some sort of near-term upside expectation. The way that I would trade something like that is I might trade the positioning for that catalyst. However, I would not want to hold it longer term post that catalyst. I would just try to trade the move, like whatever that move is. Two things I would keep an eye on, and my expectation would be probably continued options build out preceding the move. And then I would expect to see the underlying itself start to show increase in volume either very quickly if it's, you know, priced out on the day, or if it's people positioning into the move, because this still isn't necessarily like institutional level size. This is still like pretty small, right? Volume today was 915,000 at a stock that's $7.65. So 915 times 765, it's 6.9 mil. So that can easily be just a bunch of different players. That's not like big institutional sizing. That's generally, that's generally what I see. Landrush says everything related to speculation regarding Agent Orange, White House, Capitol Hill, position on Psych Therapeutics. Yeah, I wonder if there's something in progress there as far as a catalyst, maybe like expecting some sort of output from them or something like that. But yeah, I mean, that's generally what I see. Interesting find. I would essentially be looking to play the near-term catalyst or trading vol in it, because the vol edge is huge, which is super common for stuff like this. I would probably personally trade it more from the vol lens, and then I would layer on the directional stuff, but I would layer that on as you start to see the move or as you start to see more positioning. That's how I would look at it. Cool. All right, gang. That wraps me up. As always, if you need anything, let me know. Don't forget there's a new Outlier Pro tier that's launching. You can check it out in the Discord and then also on the Patreon. That one has like a 90-minute workshop once a month is the vision. So a chance to like actually meet via Zoom and talk through stuff is what I'm planning for that. Otherwise, I'll see you all around in the Discord. Be an outlier. See you guys later.